Hey, good evening, guys. Ken at Tortoise Capital Foundation's Q&A check-in for January 18th, 2024. Um, so we were looking at the pre-recorded session. We were just noticing how chaotic the markets have been since the start of the year, and there hasn't been any upside follow-through, and that's got some folks starting to get concerned about what in the world is this new year bringing and what kind of market is it? Which when you feel that kind of change in your own internal psychology, make an estimate of how many people that are traders in the world also feel exactly the same way, probably millions, and maybe ready to make a shift in their orientation or their directional bias. And so my observation was the afternoon thunder run, if in the turning point in the markets in the afternoon was not a huge percent gain, but it really was very broadly based uh, directional change from morning selling to afternoon buying and holding it into the close. That is exactly the kind of a response that you would expect from a market tries to stay one step ahead of wherever the herd mentality is. So if the herd just got discouraged that the market's not going up are now going to be prepared to go down, what would cause the most surprise to them? Well, a vigorous move tomorrow on a Friday and put them under psychological stress to say, well, gosh, should I now buy this market on a Friday and wonder what kind of stress it'll be over the weekend and what happens Monday? So, the expectation for me is simply that I know that we have rising volatility based on the daily indicator for the risk Z is showing a market that is more likely to have sharp, surprising moves. And this afternoon is sort of a natural consequence of that. So I'm expecting a big trading day tomorrow and more fireworks on Monday. And I just don't have a directional bias. I'm ready to play this in either direction. And that leads us into Hamad's question, which is he's had some success here with finding the movers through the concept of the MPRC, which stands for maximum pain range compression, which happens to be my favorite pattern, my favorite concept, my favorite decision point of all. And I'll explain why here in a second. So he asks, could please share the formula used to calculate MPRC? Yes, we can. And his spreadsheet may be a little different than my spreadsheet. That's possible. And he asked, could I elaborate on the concept a little more in the next Q&A? So, because he's heard me talk about it in a couple of videos. Yes, I will. So the reason that it's my favorite concept or favorite pattern is because it is psychologically based. It's also fractal. And I think of it as a situation in which we are after fear has already happened and a point of maximum indecision plus balance. And it was kind of the original um, compound critical state. If I, and that's sort of my current big idea, my central idea for the best trading opportunities come from compound critical states. And as I reflect on the evolution of my thinking and whatnot, I think the MPRC really was the maybe one of the earliest manifestations of that. And I want to say that it's fractal again. So the concept that I'm going to describe uh, starts off as a swing trade opportunity, but have come to realize that it's the same concept as like the morning hook. The morning hook features this psychology, the washout pattern, which is one of our structured, rules based swing trade, mechanical swing trade patterns, uh, is based on that. In some ways, the 5DD, which is also a swing, features that. You could say that the triple screen and the 551W in the swing patterns also feature this to a certain extent. So there's a very strong connection to the world of swing trading as we do it, with max pain range compression. So I think of that as a primary lens. So if I'm looking through a looking glass and I'm trying to see to the other side, that MPRC lens, I can see it in all of these other specific patterns. So that means that it's a foundational concept that applies in many ways to what's going on here. I would also say the SSC has these qualities as well. Now we're talking about that's also a fractal pattern, but really when we think about it on the 3-minute chart for day trading, it certainly has all of these qualities. The WMB3, which is primarily a 3-minute chart intraday trading strategy. Those two right there, the SSC and the WMB3, are clearly day trading in orientation. These other ones are swing trade. And that's why I say that this pattern is fractal. So let me come back now to the psychology basis of this idea. So if we think about fear versus greed, and also love versus hate, it turns out that each of these are mirror images of each other. And in some ways, I think of them as a pairing. Like to have one, you have to have the other. And so one of the common ideas about a change in psychology is that a person, a trader, let's call it that way. Or let me start with human psychology at the gross level. A person who is prone to obsessive love, exaggerated, all in, passionate, lose your mind love, is also the kind of person who can be heart dominated and quickly shift over to lose your mind all in, hurt driven hate. So there really are like mirror images of each other. It's the same thing, but the other side of the coin. And so one way to look at the opposite of the love hate pairing is indifference. It's the absolute absence of the passion and the true belief that might characterize both of those. What love and hate have in common is the intensity of the feeling. And the intensity of the feeling drives the rational process to start listing the beliefs of, well, why do I love that person? Why do I hate that person? Why do I love this trade? Why do I hate that trade? Why do I believe so strongly that this trade is going to go up? It could be that that unifying passion that is characteristic of both of those wags the dog, you know? It's the thing that drives your rational mind after the fact to rationalize the reasons, to justify it. Hey, I'm not just loving or hating you because of my heart and an impulsive decision based in emotions, but I can now list all of these factors that explain why I love or hate you. In fact, the decision to love or hate is probably heart centered, and only afterwards does the head come along and say, yeah, me too. So love and hate is the center of the decision making there too. I would argue that the decision making about fear and greed is centered in the gut. Um, and fear versus greed is the same thing as love versus hate, in my view. That you're using your fear center to say, hey, here's an opportunity that I've spotted right on the edge of my perception, and it represents a certain amount of danger if it attacks me. It's a tiger that attacks me, and it could kill me. So I'm worried about it. But I also know if I can defeat the tiger, I can feed my family and I can sell the tiger skin and be recognized for glory as a great hunter of legend, and my career will be made, and I can sell the tiger skin for a lot of money. So the tiger represents simultaneously both elements of fear and greed. Now, fear is probably the more powerful emotion because if the tiger wins, I'm dead. And that's end of story. But if that tiger leaves my space and starts running away, now the opportunity is gone. And so now fear of missing out might become the issue. So this the amount of fear that I feel is probably balanced by the intensity of the greed that I might feel if I miss the opportunity. So those two are very closely related. Like one man's fear creates another man's greed. If that was a burglar, he presents a scary face, which causes me to have fear, and it's feeding his greed to take my money or whatever it may be. So anyway, so the opposite of love and hate is indifference. The opposite of fear and greed is a doji. And this is the case where I have fear and greed in perfect balance on that little teeter totter here, of that market. Fear and greed are perfectly balanced. And the amount of money that's backing them up It's approximately the same. And so what that means is that the price that started off with fear is driving that price down until that emotional center now says some group are going to say, hey, that's an opportunity. That thing has fallen that far. It's 10% off. And that thing really does have real value here. The farther that fear drives it, the more likely person with a greed orientation, an opportunistic orientation, is going to see that as an opportunity. Aha, farther this falls, the greater the rebound that I can get a part of. And so, where there may not have been greed, that to counteract that fear, that keeps driving the price down until such time as the abundance of fear actually generates the beginnings of greed. Well, what happens when it's 100% fear and 0% greed? You get this kind of action where this thing is dropping like a rock. And some fear creates more fear, and it drives out the greed until all you have is fear. And then at some point, it's hard to sustain that. I say, well, uh, I don't have to. I'm out of that trade, so I don't have any skin in the game yet. So I can kind of look at that through my rational mind and just notice the reward versus the risk. And then when I feel like it's favorable and I have some indications, I can go join the greed side because I think it may be more likely that it's time for this to happen. And so these folks that are on the sidelines get to vote. Do I want to join the fear group or do I want to join the greed group? If they all join the fear group, and maybe that's what happens in the early stages of the panic sell-off, is that they jump onto the teeter-totter, onto the scale on the fear side, and that's what accelerates the sell-off. That's why sometimes what starts off as a doji gets a little bit of a fail and then a bigger fail until we get to runaway pain and suffering and maximum fear. Well, that's not just an emotional feeling, that's also a measurable amount of money that's actually lost by the people that were holding it inside here. So that actually equals something like a measurement of pain. How much pain are the long-term buy and holders in? Well, it's a percentage of the maximum value, which they think is the fair value. It's how much it has fallen on a percentage basis so that we can normalize the loss over time and between different instruments. We can just say, what's the percent that is lost? And it's easier to think of that as how much of my pie? That's my pie. How much of my pie did I lose? Oh, well, I lost that much. Yeah, but I had a great big pie and I only lost a little sliver of it. Okay, that doesn't hurt as much. Maybe the dollar amounts are the same, but this person with a much larger pie doesn't worry about it as much because it represents a smaller percentage. So, for a lot of reasons, percentage is the right way to evaluate pain. And we always think that the maximum value that it achieved was just the beginning of where it's going to ultimately go, because our optimistic mind says that whatever we gained from the moment we bought it to the maximum current value, that just confirms that we were right in the first place. And this is just the beginning of future riches. So we sort of take that as an automatic assumption that, of course, it'll do that. So what it should really do is do that again. So every time it makes a new high, we believe even more strongly that it's going higher. That's why when it starts to fail, it starts nibbling away at our confidence. And at first, it's not much, and every little pullback is an opportunity to buy more. That's the secret of the kata two, that the stronger the upward move, the more persuasive the buy on dip opportunity looks like. And that's why the kata two works so long. It takes a number of failed kata twos, though, to begin to persuade you that, hey, maybe that really was all there was. And maybe this thing is now on the downward slope. Oh, no. So as soon as we start feeling that, all of the buy side, all of the greed guys are starting to convert over to the fail side. So now what we have is a case where we get the initial selling and then the selling accelerates and it gets down to something like max pain. So the idea of max pain is how far has it fallen from whatever that peak was? And we are going to express that as a percentage. And then at some point, we notice that, hey, it's not accelerating anymore. It's actually starting to slow down. So, how would we measure that? Well, one of the ways that we can measure it is sort of the absolute value of the percentage of the ranges. So, if it's on a percentage basis, if each next sell off is smaller and smaller, then the fear based is running out of power. They're satisfied, they're full, they made their money, and now they're starting to worry more about protecting the gains they made, which normally gets associated with the beginnings of the greed guys who say, hey, now there's an opportunity on this side, and that the further it falls increases my hunger for the opportunity. And my belief there is that uh, the folks who can shift back and forth between those two positions, that's the traders. That's the active traders who oscillate between buy side and sell side. And so they combine both fear and greed, and they don't even feel it as fear and greed. They just feel it as directionality. It's as if a trader, instead of looking at price as an up and down thing that creates pain, have turned that thing 90 degrees and have said, you know what? I got this center line of price, and sometimes it goes that far, sometimes it goes that far, like you're driving a car. And so as long as I keep it on the road, I can speed my way through traffic and pass all the slow guys by using all of the space available to me on the road. So I don't have a preference to pass to the left or to the right. It's just which is easier. Where is there less traffic? Oh, there's more guys on the ownership side. So there's a lot of room on the fear side to get early positioning. And then if it takes off, I'm gonna do well. So they like to be the first breakout players and then add to the position based on increasing momentum to the downside. So that's why you get accelerated selling. That guys who are ordinarily adding to positions with kata 2 are not doing that. And what they're doing is they're hitting the other side. So that money is now tilting over until the point where some of these long-term buy and holders are starting to feel fear. And then they don't buy on dips. And maybe they start hedging their bets. And maybe people come in and start pushing the short side of the trade with more volume. And then they start demanding lower and low prices to come in and take on the position with increasing risk. So it starts falling faster as the buyers dry up. And now you get the unadulterated fear. Until those guys now, as traders, say, I made my money on the one side. And because they leave the fear side, there's not as much selling pressure. And the size of the ranges begins to diminish. That's fear leaving the playing field. And if we were to just draw that as a slope, if we were to draw the slope of the regression line, Instead of continuing to go straight down, it starts coming this way as it starts to bottom out. And then the difference between the unchanging regression line and where it's now moving to, as that gets wider and wider, you have actual measurable evidence that the fear is being replaced with greed. So the first guys that change, I think, are the traders. They leave the fear side and it automatically starts slowing down. And the fact that it slows down means that other guys that were on the sideline start joining the greed. And maybe the traders, the early traders, are coming in and they start joining the greed. So now all of a sudden you start getting buyers showing up. And that further slows down until you find a moment where fear and greed are perfectly balanced in terms of how much money is on either side of that equation, finds it in a matter of perfect balance. And as many sellers as there are, there's that many buyers, and they're hitting the bids and the asks. And now what you have is the absence of domination by fear or greed, and it is replaced instead with maximum indecision and balance. So you've gone psychologically from a state of maximum pain to a point of maximum balance. And now what you have is not only it's no longer dropping, but it's not rising, but it's also getting range compression. So instead of large range in a single direction, you have small range and no direction. And that's why I say the opposite of fear and greed is represented by the doji, which is a pure expression of range compression. So when I measure dojis, I go take a look at a look back period, and you pick the look back period. It has to be at least 30 in order for that to be statistically significant. But I don't mind looking at 200 because I'd like to find what was the widest percentage. So if I look at max, what was the largest percentage range of a unit of look back? Maybe those are daily charts, daily bars. The fact that it's fractal means that we're going to apply the same principle to any time frame of interest. And this psychology is still going to work. So I'll go whatever the look back period is. It's got to be at least 30. It doesn't need to be more than 200, generally speaking. That's almost a full year. This is at least, that's 6 weeks on a daily chart, 6 weeks of 5 days. So if I find the maximum, and then I go down here to the minimum, the smallest range, and then just rank order them from largest to smallest, and then perform the math on it, I can find, the average range of the look back period, and then I can compute the standard deviation, and now I can set up a range of normal. And then what I become interested in is periods of maximum let me say not maximum, but more than average range. So this is already abnormally large range days, and that has some information value. And because we might be using plus or minus a standard deviation from the average, about 1/6 of the bars will typically fit inside that range. And then range compression, if I can draw it as red, that's going to be where your dojis are. And that's going to be about 1/6 of the time, because about 2/3 of the time, because of math, you're going to find that the size of the range is within normal conditions, no new information. So if I'm interested in this as a concept, I want to know, hey, this sell-off from here down to here was so large that it was in the maximum or abnormally large range sell-off for that period of time. And the compression yesterday, the daily range yesterday was also one of the smallest compressions on a daily basis. The reason I like that is because a day is sort of a the latest battle. You know, I've got the market for equities is open 6.5 hours a day, and most of the time it's closed. So that's no, let's see, that's 17 and a half hours, which is almost like 9 hours it's closed before, and then the market's open, and then 9 hours or so it's closed after the close. So most of the time the market is not open. So all of the news which generates emotions and fear and greed because it changed, all of the accumulation of news from those two periods of time when the market is closed feeds forward into the next time the market opens and now has to be resolved right away. And now how far it moves inside that time period, the daily range from open to close now becomes of great interest. That tells me who's winning between fear and greed and what percentage are they able to achieve of dominance. And when you have a maximum pain, you have large ranges and maximum pain. And then when you get back to something like balance, you end up having small ranges and no price action. And that's the very definition of a doji. So it becomes really important in this strategy, in this approach, to be very clear about what time frame you are considering for the look back and how you're going to define a doji. Generally speaking, we're going to use the percentage as a way to compare the amount of pain and the amount of compression. So when I'm looking for a doji, what I'd like to see, if I'm looking at a standard candle between between the high and the low, what I want to see is the open and the close finish up approximately equal to each other, because that means that for the entire duration of the market being open, when the smoke cleared and the players left the field, neither side had a measurable advantage. They fought to a draw. Now, if all of the people on the green side were strong enough with their buying to offset all of the sellers and their selling, what they were now able to do was to go from a psychological condition of maximum fear with maximum pain and maximum selling. That fear is over. That's why I say it's after fear. They're in a condition where it went from big red down, a big red down arrow towards maximum pain. Those days are over. And it's been replaced with this tiniest little doji, which I can now bracket and say, you know what? Because I don't have a directional bias, I don't know which side is going to win. But what I've seen is how much power both sides have. I know that the fear side had this much power over here to make it fall that far in the face of opposition. That's how much power they had. And by comparison, the buy side, the guys who came in and started buying this, had enough power to negate all of that power, and they fought it to a draw. So if I have a small consolidation range, a range compression day, and I just say to myself, what is the upside potential of this? And what is the downside potential of this? I can just go back to the last big decisive move and say, well, until somebody tells me otherwise, I'm not allowed to be surprised if the buyers who took it to that height are able to take it all the way back up to where it was. And if they're able to do that, not only will it get there, but then everybody that bought it on this side who had a firm belief that that's the minimum fair value and they're expecting this, and they just saw this recovery, of course they're going to be ready to go. So I'm going to take a return to the previous maximum value as a reasonable target for the upside move that comes out of this range compression, because I just saw that price there recently. And I know that the fear was only able to take it this far, and then their power was offset by the buyers. And everybody that sees that as a potential, which includes everybody that bought on the way up and is looking to add more to this winter. And then you'll get the new people that are ready to start buying in case that happens. You'll see those guys start to buy as it approaches that previous high. So they're going to be front running that next breakout move. And then you're going to have a bunch of guys in here ready to buy if it breaks through. So there's an incentive for all the traders to boost that price just above the previous peak in order to at least gain a new set of buyers. So the upside argument is that the further that this thing fails, that the first leg back is going to be as big as the sell-off. And if I can compare the size of this upside move to the size of the range compression, I could get a 2 or 3 to 1 favorable move to the upside. So the downside pain and suffering compressed into the range represents an enormous difference in psychology. And this is after fear. And now greed has a chance to make its claim. Well, greed, go ahead on with your bad self. So now I got to think about, how do I design a trigger to the upside? I'll just say, look, it has to break above the previous day's high to show me new information. So if this is where yesterday's price was, and this is today, so this is day -1, and this is day 0, I have to see a price higher than yesterday's high in order to get new information that there are new buyers willing to buy at a higher price today than they were willing to buy yesterday. That was the high yesterday. That was the maximum price any buyer was willing to pay. And that's information. So if I see price higher than yesterday's high, I have information, new information, that new buyers or a willingness of old buyers to buy higher is happening. That's evidence. Okay, so now I've made the argument of, well, how do I get in? Well, you decide how much of a buffer. I usually say on swing trading, just 5 cents, just to have something to say. Like in a lot of the large caps that I'm trading on, where the bid ask spread is a penny, 5 cents can be a large move. And in the ETFs and the indexes and the futures, that's a large move. In the YM, which is the Dow 30 futures, a 5 cent move is $25. And a 2 cent move can be the buffer for my initial risk. So a 5 cent move in YM is significant. And I can now start saying, well, what does the price ladder look like? That is my pathway back to the previous fair value. And if I'm a Fibonacci guy, I might say, well, what's halfway up the stack? Because if I can see that as a 4-to-1, then halfway up is 2-to-1. And I might be willing to use that as a potential turning point. I might also be able to see that there was support and resistance levels on the way up. And now I can start calibrating these levels as potential support and resistance and say, look, if it leaves the doji area, it might only get to this point, which is the last place that it stalled. It stalled right here, and it could have gone down, but instead it went up. So that was a turning point where there was a test. So all of these little peaks of the RL10 and the Dragon become turning points that next time when it comes up to here, are the buyers going to materialize this time like they did last time? And if they do, they got it that far, and then it was a turning point, and they got to this point, and then here they never showed up again. And in fact, the selling took over and took it all the way down. So I can use the previous statistically significant price patterns of support and resistance driven by the RL10 and the peak of the Dragon as ways to start calibrating those key moments in the price ladder on the way up. And I can use that to start locking in pieces and parts and chunks. All right, so that's what the upside looks like. Well, because I have to ask all the trade framing questions, what's the downside look like? Now, that's easier to believe in because the last move that we just saw was this. So all I got to do is say, look, maybe that's just leg one. And maybe I can plan for leg two and hope for leg three. And maybe that's one giant leg one on weekly charts. So whatever triggered this sell-off might be a persistent problem going forward for that business and into the far distant future. Time open-ended could be a problem because of some new change in the business cycle that we don't know yet, but is being reflected by the insiders who are dumping shares. So the momentum can generate its own truth for a while. So the first wave of selling is over and it's terminated in this doji. The simplest way to estimate the potential of rewards on the downside is to say it can go at least as far as the first wave of selling. And the dirty little secret is on the sell side is that the next wave of selling might be even larger because the buyers had one chance to come in and succeed with it, and it was a buy on dip opportunity, and all is normal and all is well in the world. It's going to keep going. But oh no, it failed. And now instead of going up, no, it fails. And now that reinforces the fact that maybe everybody that was short here is correct. So I can at least expect it to go. If that was X, it should go another X to the downside, or maybe even X plus, and now have an accelerated sell-off because now it looks like grinding up, and then the first wave of selling, and then the second wave of selling, and then maybe the third wave of selling. And what we know is that fear is stronger than greed. So it's not unusual to see on the downside increasingly larger sizes of ranges, which is why when we see the size of the range actually begin to diminish, we begin to think maybe we've seen the worst of the selling because now the buyers are actually showing up. Until you see that happening, you could just say, hey, fear is running amok. and no brave first and second mice are coming in here to stop it and turn that into a doji. So estimating the move to the downside is easier than the move to the upside. Now, the move to the upside is actually easy the way we simplify this by saying, let me just find the recent peak and stipulate that it could go there in the same amount of time or double the amount of time. If it took 5 days to sell off, maybe it takes 10 days to recover that because it's harder going up the stairs than it is jumping out the window. But it's approximately the same time dimension. But if it fails, then I'm ready for the second way. Now, where do you hear that in our language before? How about the SSC? The SSC says, I must first have a harsh winter, and then I must have the RL10 turns, and then I'm going to accept a crossing of the dragon as the significant change in price with enough directionality in the other way that I'm willing to bet that this might be the place with that entry. That might be the place where the local minimum was put in. And I know that when the PSAR flips, it's going to flip there. And then if I've tuned the PSAR correctly, I could have a 10, 15, 20 bar directional trend in the same way that this thing was a long, painful, sliding PSAR to the downside. And I'm going to trust the PSAR until I see the RL10 has peaked. On the downside and reversed and then cross the dragon. And then if that happens, and if this thing has any kind of success at all, then the next two things that happen is that the dragon reverses and the PSAR flips and the RL30, which is slower than the RL10, ends up coming down and it also reverses. Usually later than the, so if that's where the dragon reverses from down to up, and that's a smoother curve than the pointy RL10 because of math. The RL30 is also a little bit, and that's where the RL30 changes. So somewhere in here, so this little brave speculative venture has a certain amount of time, usually 3 to 5 bars, where it has to have some success, but more importantly, no failure below the previous low. It takes about 3 to 5 bars for the RL30 to also reverse. And then that gives you an owl pattern, which is harsh winter, RL10 reverses, RLXD. That's what gives you the SSC. The next two things that you need for an owl, which is criteria 4, is the dragon rolls up, and then criteria 5, which is the RL30 rolls up, and now you can enter in that region. Well, if that's a good idea, why do you get in earlier? Because sometimes, as we said last week, sometimes that early move is the best move. And if you wait for the owl, sometimes you miss the best move. So what we are trading off is that the yellow zone, which is between my entry and my exit, where we don't know what's going on, maximum uncertainty, that's where the doji is in the max pain range compression. That's the period where it's no longer failing. because it started to reverse, but it hasn't decisively given us the owl move. This is the period of maximum uncertainty. So I don't expect it to work. I'm just not surprised if it works, because that whole region is nothing but a temporary local doji. I'm not surprised if it works. I'm not surprised if it fails. And now I have no directional bias, because that's where the directionality starts to begin once it breaks out or once it breaks down. That's why I don't like exiting inside here, because you're making decisions about directionality inside the maximum uncertainty. So don't do that. Set that equal to 0.2 loss on your position sizing risk, so you can just set it and forget it. And then your only job is, if it's going long, is to figure out how to get your stop above your entry to lock in no lose plus dinner for two. So max pain range compression then is psychologically based, because it is leveraging the power of the emotion of fear and the opposition to fear of greed, which was powerful enough to stabilize price into a range that was tightly enough compressed that we now have a favorable risk reward relationship or ratio if this thing breaks out in either direction. And the smaller the risk box, the more likely a large uncoiling of the spring is, because that's like a giant spring that has been abnormally compressed, and that equals power, which is the capacity to do work. And work is the ability to move an object through time and space to a new location. A coiled spring represents potential energy of a certain power to do work. And the work we expect it to do is to get back to the previous fair value or duplicate the sell off. The trigger, the thing that alerts us, is the fact that we had an abnormal sell off when fear ran amok. And that's the easiest thing to see, because that's when the most people are suffering emotionally and are likely to make errors in rational decision making because of the fear of existential death. Now, specifically on the swing trade, how do we calculate this? We're going to standardize it and say that the 10-day high is always the reasonable target. A 10-day high is the reasonable target, because we're going to use a 10-day look back period from today. And whatever that sell off was as a percentage is going to equal the entry after the doji. That's how we calculate the reward. The reward is whatever the mechanical entry is, which in my case for a swing is 5 cents higher than yesterday's high of the day. That's my entry, mechanical entry. The mechanical exit or the mechanical short is also 5 cents below low of the day minus 5 cents. So that establishes the amount of risk. The amount of risk is equal to yesterday's range plus a 5 cent buffer on either end of that. So it's range plus 10 cents equals the standard risk for swing trading one day at a time. And then the reward to risk ratio is simply reward divided by that risk of the mechanical risk. So that is simply taking the size of that risk box, which is the range plus 10%, and seeing how many of those bricks stack up. If that was exactly like that, I have a 3-to-1 reward to risk ratio. So, as a practical matter, how do I solve that equation for, right? I take the 30 members of the Dow 30 and rank it by reward to risk ratio. And then anything greater than 2-to-1 is automatically within the templated. I get at least a 2-to-1 if I use the wide level of risk of yesterday's range plus a dime. So that gives me my standard reward to risk ratio. That is found in the auto framer column. Now, where did the auto framer come from? Well, because on the front end of this, I had 6 mechanical swing patterns that I was routinely trading, and I was using the 10-day high as a reasonable upside target, and I was using the daily risk plus a dime as a standard risk. I was using the 10-day return to the 10-day high as a standard reward. So I started taking all of the 5DDs and the triple screens and the channeling and the overreaction and the washout and the 551W. And each one of those would generate on some given day some number of symbols that met all their criteria. Oh, crap. I got more targets than I have money. Which ones do I take? I should take the ones that have the best reward to risk ratio. So I started qualifying them or prioritizing them by ranking them from best to worst. And then after looking at that for about 5 years, I finally realized that even without the patterns, if something had a favorable reward to risk ratio, I could trade the breakout from the doji regardless of the specific price pattern that got them into the doji. Like, for instance, my favorite mechanical swing trade pattern is 5DD. And the failure pattern, the 5DDF, is the best short signal you ever saw, except for the washout failure in a bear market. But both of those are great when the swing trade doesn't work. So, what if I had 4 days down and then the 5th day was a tiny little white wing, and then it had 4 more days down again? That thing never triggered the 5DD, but the amount of sell-off had 2 big 4-day sessions of maximum selling and 1 little day of quiet buying that interrupted the 5DD pattern. And I would never see that because the 5DD never triggered. But if I just took it on the basis of trade location, that a return to the 10-day high divided by the risk gave me a 8-to-1 reward to risk ratio, that fact and that fact alone is sufficient to get me into that trade. And I know how to trade it because I have a standard mechanical entry. And then if I had symbols from the 5DD and the washout and the triple screen and all that, and I had prepared them all, I'll just take the first one, first come, first serve. And the first one of you, regardless of your pattern, that breaks out of that range is the first one that is showing abnormal signs of strength. I take it. And then I get it to no lose plus dinner for 2. And then I'm just adjusting my stop on the way up to preserve as much of the move as I professionally can. And as soon as it starts working, I'm into the kata 2 pattern of buying on dips, and I know how to frame that trade. So my upside trade management from the standard approach is well defined and rehearsed. And if this thing fails, it looks very much like a collapsing dragon. And all I do to manage that one is get my risk out of it and and trail the stop on the downside the same way. So now it turns out that a max pain range compression is the consolidated expression of how to implement all of these different trades, whether it's day trading or swing trading or some combination of hybrid trading. The general purpose concept of max pain range compression and how to compute reward to risk ratios is fractal, because now I get exactly the same thing on the intraday. Instead of the 10-day high, what if yesterday it closed here and today it opens up down here and sells off, ends in a doji, and starts marching its way up? Well, the first place I'm interested in is what happens when it gets to the high of the day, because this is where it closed and that's my gap. What if this is the first signal that I have that it's going to close the gap? Well, what if the gap was 2 times larger than the sell-off? I can now measure from the open to the low of the day and say that's how much it failed, and I can convert that data into the fail stat. And I can tell you on average of the last 30 days, how far does it tend to fall after it opens and then hits the low of the day? And I know that if the gap is abnormally large, I know that the follow through from low of the day to the high of the day can also be large. So imagine, if you will, a symbol that had a larger than normal gap down, but a low of the day that was smaller than a fail stat, and then started to close the gap. I want that one more than anything. That is the lowest risk idea that you could possibly find using math. You have a maximum gap, max pain, and then from open to the bottom of the RL10, if that's the smallest little doji ever, then you have a small risk and you have a large return just back to normal. And that thing can go all the way from the low of the day to plus range stat, which will always be well beyond this. And that's how you trade this intraday. Now, what does that look like? It looks like an SSC on the turn, and it looks like COTA 2s all the way up. But if this doesn't work, you're even happier, because now you have this sell-off from yesterday's close with a huge gap, and then this thing fell. So that's leg one, and now you're into leg two with a collapsing dragon. So what do you want intraday? You want max gap, minimum fail, and you're willing to take an SSC, because if it fails, you just smash it with a collapsing dragon and COTA 2s all the way down. And this SSC, if it works, is COTA 2s all the way up. That is a perfect expression of the concept of MPRC on intraday trading. And on swing trading, one day at a time, you just every day find the maximum pain, the smallest doji, the best risk to reward. And if it works to the long side, you lock it in. And if it fails to the downside, you collapsing dragon on the way down. And then you get your risk out before the close. And if it closed strongly enough, you might keep 1/5 or 1/10 in case you get favorable gaps, and then that becomes swing trades for the future. That is swing trading one day at a time. In conclusion, max pain range compression is my number one orientation to looking at emotions and mathematics in finding the lowest risk, most favorable trading opportunities. And when I can combine that with compound critical states to understand support and resistance in both directions based on math and turning points using the RL10 and the Dragon, I now have a reliable adaptive system of finding low risk trades routinely every day, every week, every month. To compute the auto framer, you take the 10-day high as your reward down to the mechanical entry, which is yesterday's high of the day, plus a buffer of 5 cents. That's how you compute the reward. And you compute the risk by saying the low of the day plus 5 cents is your exit. So if that's your entry, your risk is calculated by yesterday's range plus two 5-cent buffers, or range plus 0.10 equals your risk. And then I compute that reward to risk ratio every day for the members of the Dow 30, which is my modified list of Dow components plus special ones that I'm interested in, plus the ETF 30, which is the 30 most interesting ETFs in the world. And that gives me 60 candidates to find the best 5 or 10 targets for tomorrow. And I do that every day for the last 20 years. And that is the central feature of my swing trading, which is the centerpiece of drilling down for day trading and drilling up for core and position trading. The swing trading is my central organizing time frame. And when I want to day trade, I just take the best swing trade candidates and drill down and nail them. And when those work really well, I convert some of them to longer term buy and hold positions funded by markets money. Earnings from swing trades funds the core. So when I'm looking at my asset allocation between core and swing and day, this is 20% of my money, 40% of my money, and 40% of my money. Because I'm buying large positions, I need a lot of money because this is central and I'm holding overnight risk. I got to have a lot of money. And the ones that I have wider stops on have smaller position sizes. And the money that I earn over here just gets smushed over into the core. And that longer term risk is being funded by markets money. So I'm not as worried about that. This is my core capital. All right, that's everything I want to say about max pain range compression, how to compute it, and how to work with it. So if I have this open, that would be amazing. Yeah. So now when I go over and look at my daily report and I get through market location, hey, when the market is up in this area, it's at the top of a 10 and a 30-day high. It's in a critical state. Those sell-offs are not surprising. Hey, it held support here. Look what it did today. It reversed here and is starting to go up. So that's a COTA 2, and it closed within spitting distance of the 150-day high. So we get one more breakout tomorrow, and that's outrageously good. Look how strongly that doji closed to the upside, very near the high. So I know that tomorrow is going to be potentially fireworks. Well, what do I want to trade tomorrow? I want to trade the things Oops. So everything that's on my standard list of the Dow 30, everything that's highlighted are things that are better than 2 to 1. And that's true for the ETF 30 as well. Look at all the ones that are better than 2 to 1. Hey, you know what I'm really interested in tomorrow? Guaranteed is today there was a big breakout in what? The Qs. So that thing is already pushing beyond 6 month highs. That thing's already in breakaway move. So if tech is strong tomorrow and XLK was also strong, both NASDAQ and S&P 500 tech leaders, all of that's ready to go. So the first sign of tech strength tomorrow, I'm going to pound that as hard as I can. How? Well, I'm going to look for Microsoft, Intel, Tesla, but really Microsoft and Intel, and probably Apple. If any of those are better than the Qs, I'm going to buy those because that tells me people are buying the company, which is dragging the index up, which is dragging the market up. What would we call that? We would call that the radar screen and market sector target alignment, all working for us. And then later in the report, when I just go to the auto framer, these are all the ones that test out better than 2 to 1 on that swing trade reward to risk ratio. It's a buyer's market tomorrow. Look at the energy sector poised for huge moves. Look at Brazil ready to go separately from the US at 3.8 to 1. Look at treasuries in Latin America. Look at Tesla ready to go better than 3 to 1. Caterpillar, great American company, 2.5 to 1. That's the lowest risk idea you ever saw. Russell 2000, 2 to 1. Beauty. All my work is done because I can go to the framing data and find the mechanical entry, the mechanical stop, and the 10-day high. And that's what is used to compute the reward to risk ratio. Done in one. If I wanted to narrow that list even further, I could go to the hybrid swing, which is a subset of those 60, and I rank that by reward to risk ratio. Devon Energy is 6 to 1, and we just saw that XLE and XOM and USO, the energy sector, were good. Devon is great, and for a 13-cent risk intraday, I have the potential for an explosive move to the upside. Clean energy, look at Mexico, Brazil, Tesla, Alcoa, Cliff, U.S. Steel. U.S. Steel was up 0.5% today and is still at 2.4 to 1. So if I get X tomorrow, it's the second day of momentum, and that's an even lower risk idea. So you don't have to work that hard in planning. Planning is really easy, guys. Find a low risk idea with favorable reward to risk ratio routinely that can be traded in a low risk routine manner. Done. I only need 1 day's movement in my favor to start going. There's my plan. What matters more? All of the prep. Most of it's already done. You found targets, you saw 10-day highs and lows and breakouts and sides. Most of that is done. What needs to be done is your rehearsal portion and setting up your charts ready to go for tomorrow. That's what we mean by prep. Then the execution is pretty easy. Start with the gap and then look for the reversals of the RL10, and then get your risk out, and then convert it to a 30-minute chart. Done. And then your assessment is, how well did that go? What could I have done better? And then make micro improvements every day, every week. You don't even have to do that every day. You might decide that the only day that I'm going to trade this week, Monday, Tuesday, Wednesday, Thursday, Friday, is let me wait to see it's near the market closed, overbought or oversold. If it's in an exaggerated state, based on a 10-day look back, which you would use the 10-day NDX, I want to see the market close in that area, because now I know that that's a critical state, and it could be a big move here or it could be a big collapse. So I'm going to wait and see. Wednesday, it closed with an extreme reading in the NDX. That means Thursday is going to be my prime time to trade that week if I'm trading this stock. That might be a day that you maximize your effort in learning to trade this particular style. Now, there's always something moving on any of these days, and you just got to find the mover. But when the market itself is in an exaggerated critical state, you now get compound critical state, and that's what tomorrow looks like. You know where the market is right now? Here's my 150-day look back. It's in the top 10% of the 150-day look back. So on that, it's over. Here's my 30-day look back. Oh, it's in the top 10%. That's good. It's near the very top, in the top 10% of the 10-day. That's a compound critical state just based on trade location. We had a strong buy, and now it's been monkeying around. It dropped below the Red River. It's now ready to go strong or big fail. We are in a compound critical state on a Friday, and we just had an intraday recovery today. What did that look like? It had a 3-day sell-off, and today it gapped up, sold off to here, and then went straight down. So it found support, and closed very strong. 1 day of recovery, 2-day of recovery. All it has to do is break above today's high, and then all it has to do is break above this price, which is about 478.5, and it breaks out above a 150-day high. That price right there is the 150-day high, the 30-day high, and the 10-day high, and that was recently made right here. It could not break higher on those 2 days, and in fact, it sold off all the way to here, but it didn't make a 10-day low. It reversed and closed all the way to here. Now, even if you didn't get that move, you got to recognize that that is all that stands between us and a new breakout. That's all. So there you are. That's how you use the daily report efficiently to rapidly find trading opportunities for your subset of symbols. And I'm doing the work for you for 60 reasonable targets every day. You can refine that as much as you want. You can combine that as much as you want with mechanical swing patterns and all the other reasons why we might be interested in shorter term swing trading. All that's there waiting for you. but finding priority targets could not be easier than what I just showed you. All right, that's today. Let me take a 3-minute break and set us up for the nightly podcast. We'll be back in 5.